Brokerage House Live. I'm Vanessa Collette here at the Canadian Investor Conference, Toronto. I'm very excited to have Grant Williams joining us. He is the Chief Investment Strategist at Maudlin Economics and author of Things That Make You Go, Welcome, Grant. Great to have you here.
It's great to be here. Thank you.
Now, Grant, what is K-wave theory? And is it similar to Elliott wave theory?
It's a little different. I spoke yesterday, and there were a whole bunch of people here who've been listening to mining companies talk all day long, and they're probably up to their head in rocks. So I figured I'd change things up there. It's long economic cycles, and this is a study of the business cycle by a long dead Russian called Nikolai Kondratiev, who published a book in the 1920s about Kondratiev theory. So it's essentially 53-year cycles of economics and how it fits. If you overlay it to history and today, it tends to pick out a lot of very important events. So it was a little more esoteric than the mining space, but hopefully people got something out of it.
So what does K-wave theory tell us about today?
Well, K-wave theory, essentially, if you project it, it tells us that we went into what's called a Kondratiev winter in 2000. And this is the part of the business cycle where we get a lot of debt gets expunged, we get deflation, we get equities going into bear markets. All the bad things tend to happen in winter. It's kind of a washout stage. And when I was talking yesterday, I was highlighting that technically we've gone into this winter phase, but the difference being because of all the low interest rates and QE1, QE2, all the devices being used by the central banks, they've kind of held off some of these bad things. They've kept deflation at bay. And with low interest rates, they've forced equity markets into bull markets. But if you look on the balance of probabilities, we are in a Kondratiev winter, and if this funny money blitz doesn't actually take hold, then we could see some very nasty things happen. Okay,
is there hope for summer at all, or?
Well, look, after winter always comes spring, and then summer, and then we go back in. And these cycles are long. I mean, as I say, they're 53 years long.
Okay, so how far are we in the cycle?
Well, according to the Kondratiev wave, we're about 14 years through about a 17 and a half year part of the cycle. So according to this, there's 3.5 years. Now, these aren't set in stone. It just so happens that if you look at them through time, they do tend to mark a lot of major tops and bottoms. So people pay attention to them. A lot of them think they're hokum, but a lot of people pay attention to them, and there are too many coincidences to just dismiss them.
So what can we expect in the next 3 years?
Well, it's a great question. Ordinarily we'd be further down the track here. We'd see deflation, outright deflation. We'd see a lot of debt getting expunged, but we're not seeing that because of the low interest rate environment and because of quantitative easing.
Is it because of all the intervention?
Correct. And so that's really distorted the signals. So what people are looking for are signs that those interventions are having an effect, i.e. returning us to growth and getting rid of the spectre of deflation. But you can see in Europe, they're fighting deflation as hard as they can. So have they cured it, or have they just pushed it out and extended this winter period? We really don't know, but at the moment it looks suspiciously like the latter to me.
So what's your take on the global economy?
Well, it's weak. I don't think there's any disputing the fact. We're not really seeing any growth. We're seeing little peaks in a pretty poor cycle, but we're not seeing the kind of growth that $4.5 trillion of printed money would suggest that we would have. Japan are struggling to get growth. Abenomics is working for the time being, but the implications of that down the track are pretty poor. Europe, there's no growth in Europe whatsoever, and so until we see real growth. And that includes China, which has slowed down to 5.1% now. Until we see some real growth, then I don't think we're going to get out of the woods.
So how could we see growth happening again in the economy?
Well, the central banks are pumping so much money into the economy in the hope that will generate some kind of organic growth. But until you get people out there who aren't afraid to put their money somewhere safe, and they're going to invest it, they're going to speculate with it, and this is all part of the game of having low interest rates, is to force people out and put their money to work in the economy. But we're just not seeing it. And so people need the confidence to be able to invest and confidence to be able to spend. And I don't see how that comes with more of the same. They're kind of pushing on a string now. So something needs to change, and it's going to be something mental. It's going to be a confidence shift, and it's hard to see how that confidence is going to shift for the positive without this growth. So it's kind of chicken and egg. But to me, we're going to see a negative shift in confidence, and then we could see this winter take hold again.
Is it Warren Buffett that says that you should be greedy when people are fearful?
And fearful when people are greedy, yeah. Look, it's absolutely right. And a lot of people have made a lot of money from buying things when everybody else is selling them. You know, we're here at a resource conference, and the junior mining sector is perhaps the best example of that anywhere on the planet right now.
Right.
But again, it's not just, you don't just buy things because people are selling them. You buy things at periods when the sentiment is so washed out that it's hard not to make a profit. And it doesn't feel to me that we're quite there yet.
Okay, so what are you doing with your money and what are you recommending right now?
Well, I'm firmly on the record of saying people should have a healthy allocation to gold. I think it serves many purposes. I'm not a trader of gold, I'm an investor in gold, so I don't tend to look at the price on a day-to-day basis. I don't like equity markets here. I think they're fully valued, and I think even though we're seeing an endless procession of new highs, the risk reward in being on the sidelines right now, someone said yesterday on our panel that if the market doesn't crash, it could go up exponentially, and that's absolutely right, but the risk that it does crash to me is too great, so I don't like equities. I think people have had 5 years of great returns. Now's the time to be more cautious, sit in cash, look for assets that replicate bond yields. There's pockets of real estate all over the world that will give you a decent income. In Singapore, we've been buying a lot of farmland, not in Singapore, but all around the world. You get that inflation hedge, plus the coupon from the goods that you sell. So there are ways to protect yourself, and I think right now it's time to be cautious.
What do you think of emerging markets?
Well, I live in the middle of a lot of them, so I have to be kind of bullish on them. And I think there is real growth in Asia. It's probably not as strong as it has been, and it has been strong enough to carry a lot of the world for the last couple of decades. Mm-hmm. So that's starting to moderate now. But I still think there are tremendous opportunities in Asia. The demographics in a lot of places in Asia are some of the best in the world, particularly somewhere like India. So you are going to see growth in Asia. But again, as I said, it's needed to carry the rest of the world, and the question is whether it's going to be strong enough to do that with a falling European economy and a struggling US one.
Well, thank you so much for joining us today, Grant. It was a pleasure having you.
Likewise, thanks for having me.